Hello, let's continue from where we left in the previous session. So the market provide the price, correct? As we remember here, the market is providing the price here, and the bond provides the scheduled cash flows. If you see here, correct? The calculator processes this cash flows and discounting cash flows until they match the price of the bond, and finally it would give you the YTM, internal rate of return. Now let's move to the critical assumptions we are making while calculating the YTM, yield to maturity. What does this actually we are assuming here? YTM is a powerful, but it is calculated assuming three things. First, it assumes you hold the bond until its maturity. Second assumption, the issuer would never default. Third assumptions you are saying, it assumes you can reinvest every coupon payment you receive back into the market at the same YTM rate. Suppose YTM rate is 6%, market rate is 5%. Are you actually you are able to reinvest with the 6%? Answer is no. You would have to reinvest at the 5% coupon. So those assumptions are actually unrealistic. If interest rates fall, you will reinvest at lower rates, and your actual realized return will be lower than the quoted YTM. This uncertainty is known as the reinvestment risk. In this diagram also, these three assumptions are shown, like it rests on holding to maturity. If you are holding a bond till maturity and there would not be any credit risk and there won't be any default and reinvestment, you would get at the same YTM, which is not true, correct? But to just understand things beyond how much internal rate of return, generally investors use the IR or YTM. Now let's look at the relationship between price, yield, and then summarize. So let's connect price and yield. If a bond coupon is lower than the market yield, it trades at a discount. Correct. Here in this say like less than $100. If the coupon matches the yield, it trades at a par value in this scenario. If you see here, correct. If the coupon is higher, then price starts uh, trades at a premium. Sorry, it's a premium. Remember, regardless of where the price starts, it will drift towards par as it gets closer to maturity, which the phenomena is known as pull to par. To use the indenture document to understand your legal protection, and use current yield for a quick income check, but rely on YTM for relative value, keeping its reinvestment assumptions in mind when we are talking about YTM. What have you learned till now? Now you have grasp on the legal chassis of the bond and the mathematical engines, which is current yield and YTM, that drive the valuation. Same things is depicted in this diagram. Thank you. Thanks. I'm stopping now. We'll continue here in the same session. But meanwhile, I want to tell you, please go through the accompanying ebook which is provided as part of this training session. It would be in PDF format. You can download it. Thank you. I'm stopping now. Hello and welcome back. Today we will build the foundation of fixed income again by exploring the legal, regulatory and tax framework that govern the debt securities. Correct? Legal, regulatory and tax frameworks. Okay, now let's move here. So to understand the fixed income, we must start with the contract. Okay, the contract is called the bond indenture or sometimes the trust deed. Think of this as a rule book of for the bond. This is again repetition, but it's again I just want to grasp the things in detail. It sets out the exactly what the issuer must do, like paying the interest on time and what rights you have as an investor. Because it is impractical for a company to sign a contract with thousands of individual investors, a trustee is appointed. So they who all are the parties here? The issuer, the bondholders, and the trustee is the party here. Trustee acts like a referee here, monitoring the issuer to ensure they follow the rules and taking action if they do not. So if we see in the diagram which shows the flow of the relationship, this is the left hand side where the indenture is signed and bondholders. So there is a like issuer and then bondholders, correct here. So bondholders actually lend the money to the issuer who needs the money, and the trustee sits in between of that. The issuer signs the indenture. As an issuer, you sign the indenture, not directly with every bondholder they have to do. The trustee acts as a fiduciary or guardian here for the bondholder interest, while cash flows move between the issuer and the investors. Now let's talk about the legal identity of the issuer. So we must ask who actually owes you the money. This is the legal identity of the issuer. Okay, it is not always the main brand name you see on the product. It might be a subsidiary or a holding company. This matters because a subsidiary might be safer or riskier than its parent company. In a structured finance, we see a special purpose entities or SPVs. These are separate legal boxes created just to hold asset and issue bonds. A key concept here is the bankruptcy remoteness. If the main company goes bust, the asset in the SPV are usually safe for the bondholders. So let's understand again through the diagram, which helps you to distinguish the legal entities. If you see that at the top, this is your parent company. Okay, it can issue a debt, but so can its operating subsidiary, which is this one, or a holding company in the middle, and special purpose vehicle entity SPV. This arrow indicates assets moving from the parent company to the SPV. Correct? SPV is a walled off or bankruptcy remote, protecting those specific assets from the parent financial troubleness. Now moving to the sources of the repayment. How will you get your money back? This depends on the type of the issuer. For the national government, repayment comes from their power to tax and print money. We call this full faith and credit. For local governments, it might be local taxes or revenues from a specific projects like a toll bridge. For corporation, repayment depends on their ability to sell goods and generate profit. Finally, for asset-backed securities, ABS, your repayment comes directly from the cash flows of a specific pool of assets like mortgage payments or by homeowners. So let's try to map this out again where the money comes from. So repayment sources are, one is a sovereign, which is your uh, government bonds which are paying from the tax power, like people pay the taxes and you get the your repayment of the coupon. Corporate bonds, like which is companies like Toyota or something, their operating cash flows is your you would get as a cash flow back. And asset backed securities, which is this one, which like pool of loans, like all the homeowners loans would be combined together, created a pool, and you would get money from that pool, and which like as a home buyer you pay as an EMI and pay as an interest as well, which also come as this. So this is your repayment options. Now let's talk about the collateral and seniority ranking. So what happens if the issuer runs out of the money? This is where the collateral and seniority matters. Secure bonds have a claim on a specific assets like a factory or equipment. If the company fails, you can sell those assets and get paid. Unsecured bonds, often called debentures, rely only on the company's general promise to pay. We also have a pecking order called a seniority ranking. Senior debt gets paid first, then subordinated or junior debt gets paid only after senior debt is satisfied. Being higher in this rank generally means you recover more money in a default scenario. So let's imagine payment priority at very bottom. Okay, they if you see here, senior unsecured debt, subordinate debt, and equity here. So in this diagram, and secured debt. So these is the ranking. The first, these people will get paid if something goes wrong with the company. Then see, then probably the senior unsecured debt, if any money left, then they would be paid. Then subordinate would be paid, and at the last, equity and shareholders are being paid, because equity and shareholder are considered as a partner. If company fails, partner will not get any money. So that is what you need to understand. Now let's understand the concept of credit enhancements, when you which is also sometimes referred in as short term CE. Okay, what does credit enhancement means? So sometimes issuer need to make their bonds safer to attract investors. They use credit enhancements. There are two types of credit enhancements: internal enhancement, which are built into the bond structure itself. For an example is an over collateralization, where they place more asset than a bond is worth. And the second one is an external enhancement, involves a third party. For instance, a bank might provide a letter of credit promising to pay if the issuer cannot, or an insurance company might issue a security on bond. These external guarantees transfer the risk to the stronger entity. So let's look at to the diagram. Credit enhancements into two categories. One is an internal credit enhancement, another is an external credit enhancement. So if left hand side, which you see the internal method, which includes the subordination or over collateralization. So we understood the over collateralizations, correct? To adding extra assets, you can get it. On the right side, which is an external method where bank can guarantee you would get the money back, or insurance company would guarantee. Both branches serve the same goal, making the bond safer and for you. Now let's talk about bond covenants, which we have previously discussed, but just we will reiterate again. So to protect your interest, indenture contains covenants. These are the legal promise. We divide them into two categories: affirmative covenants and negative covenants. Affirmative means they must pay the tax, must um, pay taxes and maintains insurance. Negative covenants means a restriction. They stop the issuer from doing things that hurt you, like issuing too much new debt or selling off all their best assets. While negative covenants restricts the company's freedom, they are crucial for preserving the safety of your investment. Now let's talk about the tax consideration. How does that makes a difference? Where a bond is issued determines the rule it follows. Domestic bonds are local companies issuing in their local market. They follow the local laws. Foreign bonds are the foreign companies issuing in the local markets, like German company issuing dollars in the US market. These also follow the local country strict rules. However, euro bonds are different. They are issued internationally and are not regulated by the country of the currency they use. For example, a dollar bond sold in London, Eurobond usually have lighter regulations and disclosure requirements. So let's look at this diagram to understand the regulatory path. With starting with the bond issuance, we ask where to issue your bond, whether in the local market or international market. So if it is a local market, then domestic bond you are going to issue, or even in the local market, whether it's a domestic bond you want to issue or foreign bond you want to issue, but high the regulation because you are on local market. If you go for the euro bond, which is an international market, the regulation is a lower, and this path is often preferred by issuer for the flexibility. Okay, this path is usually preferred for the issuer. Now let's talk about the uh, sorry, I've considered regulatory consideration. Now we'll talk about the tax consideration. Finally, we must consider the taxes. So generally the interest you receive is taxed as an ordinary income. If you sell the bond for a profit, you pay capital gain tax. A special rule applies to original issue discount or OID bonds. These are issued at a discount. Even though you do not receive cash until maturity, you often have to pay the tax on a portion of that discount every year as if you receive it. For example, some bonds like certain US municipal bonds are tax exempt, meaning you pay no federal income tax on the interest. So there are different kind of bond returns. One is like if you are getting an interest that in the ordinary income tax bracket you would come it. If it is a capital gains, then it is a capital gain tax. And OID discount means if like zero coupon bonds, you get money in advance. So sorry, your actual money you would get at the year 10-year end or whatever the duration maturity, correct, according. So you have to so as similarly shown in the diagram, the main on top you see the bond returns. It's break down into three types. First is the interest, which triggers ordinary income tax. Second is capital gains for selling the bonds, which trigger the capital gain tax. And the third one is OID discount, which triggers an implied annual tax even without cash flow. Each type has a distinct tax repayment or tax treatment. Thank you. Thanks for watching. I'm stopping now.